Hi, my name is Vasil. Welcome to the Finformer, where we'll make sure that you're always financially informed. Today, we are talking about things that you absolutely essentially need to know about the global economy right now. Let's kick off with a quick roundup of what's happening with the interest rates around the world. In the most recent cycle of interest rate decisions in May and June, countries like Australia, European Central Bank, England, New Zealand, and India announced interest rate hikes. As a matter of fact, in a surprise move, after taking a 2 month hiatus, the Bank of Canada also announced a 25 basis point hike. Now, if any of you are not surprised by that move, maybe you don't have a variable rate mortgage like I do. But unlike these countries, the Federal Reserve, after a 15-month long cycle of 10 back to back interest rate hikes, where they raised the interest rates by a whopping 2100% to 5.0 to 5.25% range, decided to take a breather. In its June meeting, the Federal Reserve decided to keep the rate steady, and therefore the common man finally got a break. It seems this decision came in light of the downward trending inflation, as the inflation or CPI came in at 4% versus 4.9% last month, and core CPI came in at 5.3% versus 5.5% last month. Very impressive. But don't let that fool you. The Fed hasn't left the ring. The fight isn't over yet. The Fed is still talking tough, saying that there are still more hikes in the pipeline for the rest of the year. But there seems to be a disconnect between what the Fed says and what the market believes. If you look at the graph that's displaying on the screen right now, you will see the S&P 500 dropped from 2 p.m. to 2:30, which was the half an hour right after the Fed decision, and then it recovered and closed pretty much flat by the closing bell for the day. So it looks like the Fed has lost all credibility. And why wouldn't they? Since they are the same people who brought us blockbusters like interest will remain low in 2020 and inflation is transitory in 2021 and 22. Now, like me, are you also thinking, why did the Federal Reserve decided to skip? Well, here's what I think. Inflation is trending downwards, and I believe that is a good enough reason for the Federal Reserve to think that what they've done so far is actually working. And probably they do not want to overkill with the interest rates and push the economy into the red zone. But I think there's more to this whole story. So let's talk about it a little bit more. I know we've been hearing all the cheering that has been going on the news channels and by the commentators about how resilient the US economy is. And all that based on the job numbers, given how historically low the unemployment is. But that low unemployment is having to take on record levels of personal debt to make ends meet. As per data released by the New York Federal Reserve in May, Americans now owe nearly $1 trillion in credit card debt. And all that because they're struggling to pay the bills given the high inflation and the higher interest rates. Also, for some reason, I don't know why commentators keep undermining the fact that a big indicator of economic health of a country is the GDP growth rate. And for the US, that is trending downwards right now and perilously close to zero. And therefore, it's easier for it to cross over to the negative territory if interest rates are pushed too hard. Also, in its statement, the Federal Reserve said that it is looking at the cumulative impact of all the previous interest rate hikes. What that means is the Federal Reserve is not looking at each interest rate decision in isolation, but looking at the impact of previous interest rate decisions that were taken last year or in the last couple of months, which possibly haven't fully translated or flowed into the economic indicators right now. These kind of indicators are usually called lagging indicators. So things like unemployment, corporate profits, these indicators usually change after or some time after the GDP has actually declined. But you see, I don't think these are the only reasons that played into the Federal Reserve's decision to pause the interest rate hikes. In my opinion, there are two other major factors which could have played into the decision to pause the hikes at this very point of time. Number one, in March of this year, 2023, the United States decided to sit in a time machine and go all the way back to 2008 to relive history. Just like a roller coaster with all its ups and downs, the United States saw a number of US banks collapse just like 2008 with Silicon Valley Bank collapsing on March 10th, then Signature Bank collapsing on March 12th, and then the First Republic collapsing on May 1st. All of those within a matter of a couple of months. And in the meantime, we had the Federal Reserve and the United States Treasury Secretary Janet Yellen telling us that everything was good, the financial markets and the financial system is stable. The Silicon Valley Bank collapse was the second largest collapse in the history of the United States. That happened in March of this year, but that was very quickly dwarfed by the collapse of First Republic Bank in May, which became the second largest bank to collapse, and all that within a span of 2 months. Now, I know that doesn't give us a lot of confidence, but for some reason, Federal Reserve and the Treasury Secretary think it was a good idea to give a statement telling us that the worst is over and that the financial system is stable. But you know what I think? I think the other shoe is about to drop. The work from home movement and the high borrowing costs have turned commercial real estate, especially office buildings, into an investment nightmare. While residential properties are still somehow holding on for dear life, commercial properties pose a significant threat to the banking system. Any further stress from higher interest rates could actually be a final nail in the coffin. Apart from the stress in the banking system, I believe there is another reason that the Federal Reserve paused the rate hikes. I think the Federal Reserve is taking cues from the economies around the world. Like I said before, last year in 2022, global economies started hiking interest rates to tackle sky high inflation, which they previously believed was transitory. But sudden interest rate hikes, coupled with the other gifts given to us by the COVID 19 pandemic, such as stubbornly high inflation, supply chain bottlenecks, and high levels of indebtedness, made the global economies very, very fragile. So now we are left with a broken global economic system. Germany has already been hit by a recession. Eurozone is in recession. And on June 14th, Reuters reported that even New Zealand is now recession land. China made a surprise rate cut as the post-pandemic recovery seems to be losing steam, evident from the weak economic data. Questions are already being asked whether the European recession would impact the United States. Now, here's what the Federal Reserve of New York economists have to say about this. When Europe catches a cold, the whole world sneezes. So people inside the Federal Reserve believe that the US, along with the rest of the world, is not immune to a global recession. The ECB, that is the European Central Bank, actually raised rates again on June 15 in spite of being in a recession. Now, I think they are setting a dangerous precedent for the US, which, if followed, would put the US economy in serious jeopardy. Even if the Federal Reserve feels that they can have a controlled recession or a soft landing, as they call it, I'm sorry, I do not have trust in them. I do not have faith in them because they are the same people who gave us transitory inflation. Now, I'm sure we cannot afford a transitory recession. A recession is a genie that's hard to put back in the bottle once it's out. In fact, in my opinion, this is how the Fed will and how they should react if recession does show up. But before I tell you what I think, please smash the like button, hit subscribe, hit the bell icon, and share with us your thoughts in the comments. And now you're allowed to watch this masterpiece.
Hey, I'm not afraid anymore. I said I'm not afraid anymore. Do you hear me? I'm not afraid anymore.